they've lost so much money and they continue to lose money. If you just set the goal at only owning companies where you're confident that in the long run you won't lose money, and then you step into situations like this where everyone else is betting that the thing's going under, you can make a lot of money really fast, especially in a time of a crisis where you have all these hedge funds and mutual funds out there with their shareholders looking at they're down 50% this year. Oh man, now my retirement's going. And then what they do is they forecast the negative trend into the future and feel like it's going to re-happen next year, when in fact the big investors out there pricing the market and realizing that it's time to buy, because if you discount the cash flows at the current interest rate, which is 0%, it's difficult to lose money. And actually owning stock is a natural hedge against inflation, because the future cash flows that you make are inflated because it's in future dollars. What's up?
What's your standard holding period on one of these securities?
My standard holding period? I mean, it really depends. What I'll do is I'll rank my top 50 or so, and then I'll calculate the percent upside that they have, and I'll calculate my confidence in their price to cash and price to book, and then I'll rank them 1 to 50. And I'll sort them into groups kind of. And basically, if you have a company that's up here and the upside is 2,000%, and it goes up 400%, then your upside is not 2,000% anymore, it's 500%. So it'd kind of be down here maybe. And so you'd sell some and buy more of these. So it's kind of relative on how volatile these companies are as far as your holding period. And the more frequently you can find these companies, and the more frequently you allocate. But my goal is to pretty much hold for a long period of time, because most of my investors have to pay 40% taxes if I buy and sell in a year. So that's kind of, in order for me to justify buying and selling, I need to have at least a 50% confidence margin, which means that this play needs to be at least 100% better than this play. So if this one has 500% upside and this one has 1,000% upside, and my confidence on a 1 to 10 scale is a 9 and a 9, then I could justify switching. But other than that, the goal isn't to trade. The goal isn't to skim small quantities of money. The goal is to, over the long run, allocate into positions where you're confident that your diversified portfolio will not lose money, and actually every stock that you own won't lose money. You want to be very confident in everything you own, because otherwise, if it goes down 50%, which it could because it's already hated and people already don't like it, are you going to buy more or are you going to panic? And in most of the cases, I would just buy more because it's already hated. I already determined that I like it, unless there's news came out that, something really terrible happened that justifies that I sell it and allocate it into something else, and sometimes I've done that too. But the goal is to not lose money. I mean, any other questions or? Yeah.
How do you assess risk?
It's kind of like a gut feeling, 1 to 10. There's certain things that are very risky, and there's certain things that are not risky. It's definitely not volatility. There's all sorts of risk. There's risk coming from things you do not know. There's risk, I would say risk in the stock market comes only from overpaying. But as far as things that I look for, dilution, history of the company diluting. So if they keep giving shares away to try to raise capital to do something. There's a couple of companies like AOB, American Oriental Bioengineering, I think is what it's called. They keep diluting, but they keep growing faster than they dilute. So I said that that was a good idea, but I don't own it anymore. I own calls on it, but there are companies, especially when you're dealing in the foreign sector, that don't necessarily, in my opinion, look to reward shareholders for owning their company, but prefer to grow their company. And as management, I mean, some management gets compensated based on growing their revenues, and you kind of have to understand how the companies work. So like a couple companies that I would say have made questionable decisions in the past, but I still own. You have Zing and QXM. And if you understand the deals that have gone into them, I own Zing, I don't own QXM. But, if they are what they say they are, it's a great deal, but who knows? And you have to take that, with a grain of salt, and because I know that I don't know, 100%, because, annual reports, they put in what they want, and, granted, some of them are audited, but you have to question the validity of all your information sources. And in the price sectors that I deal with, it could be a big one, could be 1,000% gain, but it also could be nothing. And I don't know. I haven't been out to the mine. They have I think it's a molybdenum. They have a mine that's worth a lot of money, significantly more than their market cap. But yeah, risk comes from pretty much not understanding what you're doing. There's currency risk. There's dilution risk. There's the risk that you're being lied to. There's the risk that, and there's maybe a large hedge fund out there that has to liquidate and you don't know about it. So, in the next 3 or 4 months, they might be selling, 10% of the company, and that could potentially drive down the stock, 95% if there's not a large following. So there's all sorts of things that, could be perceived as risks. That's why I try to buy bottom of the barrel companies that have a future. Nobody appears to want them if you look at their stock price, but when you look at the fundamentals and try to understand the company, it's hard to see that, they look like they're going to go bankrupt, but they're making money and they're growing and they're selling at less than book value. And you listen to their CEOs, which of course are optimistic because that's the CEO's job. And they generally have stuff in their pipeline that will eventually have a positive impact going forward. So hopefully, I didn't bore you guys today. But yeah.
So as a portfolio, do your entire portfolio these small cap, or do you balance it with some blue chips?
Is Citigroup and Bank of America and Fifth Third Bank, are they blue chips? Like when they're hated, they're not really a blue chip. Like some of these things are sold into the gutter. But I try to diversify across gutter companies. So right now, most of my portfolio is denominated in companies that no one's ever heard of and nobody wants. And then I just wait for them to realize that they just gave me a great deal. And sometimes that takes a couple months, sometimes it takes, I'm willing to wait. I'm willing to be patient. But let's see, the biggest company that I bought, I don't really buy shares of the larger companies. I buy call options on them because you can, and you can wait on them. But yeah, I don't own blue chips. But if I did, I wouldn't be able to play for 1,000% returns. I'd be playing for, 50% returns. And, risk in that instance still comes from overpaying. But the difference between those companies and these companies is if you have a large position in these companies and you need to sell out, in the next 2 or 3 months, good luck, because you're going to drive it down, 50% or more, because there isn't necessarily a market. It's kind of like the joke, you go and you buy a bunch of this company stock, and it's time to sell, and sell to who? There isn't. Who are you going to sell to? Because nobody knows about them. But it's just something fun to do. But yeah, I try to diversify across 20 or so, sometimes 10%. I try not to put any more than 10% of my portfolio at a time into any of these positions because of the relative uncertainty. And the great part about doing that is, say you have 10% in a company and then it goes down 50%, then you can put more money into it because it's only 5% in your portfolio if your portfolio didn't do anything. So it allows you to buy more into companies that you still believe in that have gone down. But at the same point, once you've got 10% in your portfolio in something, if it keeps going up, you really can't buy more. But if you have 10% of your portfolio